Hi, it's Malcolm and I'm joined by my colleague Wayne, and today we're going to be talking about buy-to-let mortgages. Buy-to-let has always been there, hasn't it, Wayne? But I remember this really taking off in the mid-90s, just as I was getting started. I seem to remember that's when we started getting going.
Obviously, as an old fogey, I remember when it wasn't that common, to be fair. But you're right, after sort of the deregulation of the building societies and the banks starting to become freer to lend in more areas, as you say, it became much more popular, and banks began to sort of compete against each other. So it certainly started to really take off in the 90s, as you say.
So I suppose if you went back further than that, this would have been the domain of the more professional landlord that would do this for a living. Yeah,
and the more sort of commercial lending type banks would maybe finance it, but then as the market freed up a little bit, you started to get the sort of, I won't call them amateur landlords because I'm sure that they are, but landlords who didn't see this as their only living, as opposed to previously where you would have had professional landlords and that was their business, and they would raise the funds on a commercial basis.
And then, do you think this is to do with people losing faith in things like pensions and other investments, whereas property tends to be something that they know and they understand?
I think there's definitely an element of that. As you said, the pension industry, there was a lot of bad press about pensions, and whereas historically, your employer would often contribute a large chunk of your pension contributions. That started to disappear, and people were having to make their own arrangements. And I think a lot of people sort of looked at it and thought, hang on a minute, property prices generally go up over time. Yes, there are always peaks and troughs, but the general curve is upwards, and I would rather invest my money in that than maybe a pension fund.
Yeah, and I suppose some of these people that were getting into this in the 90s and early 2000s might have been people that have benefited from seeing properties that they already own go up in value.
Exactly, especially if you've lived through that period where you've seen maybe a couple of property price booms. All of a sudden the value in your house has gone up by 50%, 60%, sometimes doubled, whatever. Then you might think, well, I want to replicate that, and that's then going to be a good investment for my future.
So typically, lenders will want you to put down a higher deposit for a buy-to-let than they would do for a residential. I think the reason behind that really is that if you fell into some financial difficulties and you had to decide between paying the mortgage on your own residential property and you happen to lose your tenant at the same time, it's all gone completely wrong for you, and you've got this buy-to-let, you probably prioritise paying your own mortgage. So the banks want to minimise their risk by looking for a higher deposit to come down. Now, the amount of deposit that needs to go down ebbs and flows depending on what's happening with the market. But typically, Wayne?
Yeah, typically I would say you'd typically be safe with a 25% deposit. As you say, there have been times when lenders will do it with a 20% deposit. When the market was booming, we even saw sort of 15% deposits. I think if you work to a 25% deposit, you will always, whatever the market's doing, probably be in with a good shout.
Okay. Now we often have first-time landlords come to us, that probably homeowners, looking to supplement their income or look for an investment for the future by building a property portfolio. How do people do that? So obviously it starts with one property.
Yeah, exactly. And first of all, a lot of the people who have seen that property growth in the value of their own home, they've got latent equity in their own home. So often people will look to release some capital from their own home in order to fund the deposit of their next purchase.
I've done that on an offset mortgage before, so kind of you can draw that money down as and when you need it.
Exactly, yeah. So that's often a starting point for people looking to get onto the landlord market for the first time.
And then, so they've released this money out of their own residential property. They could maybe perhaps go and buy one for cash, or they could spread
it and buy two or three. The key to success is always going to be what sort of return are you going to get on your capital. So, for example, it might be worth using that lump sum, as you say, to buy maybe 2 or 3 houses, which might not be the most valuable houses, but they might be in very good rental areas, where, for example, near to a university where students often rent. And that actually then gives you a very good return on the capital investment that you've made.
So you mentioned that universities, so So these would be house of multiple occupation, HMOs as known in the industry. So they would normally attract a higher yield, a higher monthly rental amount?
Yeah, obviously with the HMOs, there are more regulations come from it, because obviously they have to be registered with the local authority, and there are more rules and regulations, and lenders do therefore tend to treat them as a slightly different category. But certainly the reward, because if you've got a house with, say, 4 bedrooms in it and 4 students with a room each paying their rent, often that would generate more than if you just let that to, for example, a single family who were renting the whole house, sort of thing.
Okay, got it. So through the 2000s, buy-to-let really became very popular. Lots of people, dinner party landlords, this would be people talking about the values of their investments going up and the yields, etc. But the number of first-time buyers was going down, and that's not a great thing. I think we all understand that getting younger people onto the first-time buyer property ladder is a good thing for the overall economy. So the government, about 2015, decided to try and do a bit of social engineering to change this, to make it less advantageous for landlords to carry on buying. So how did they go about doing that, Wayne?
Well, basically they changed the tax situation. So over a period of 4 or 5 years from sort of 2015 onwards, 2015, 2016, whichever, but they phased in a series of tax changes as to the way that the rental income was taxed.
So prior to that, you could offset all of your mortgage interest against your tax bill. So if you've got your rent coming in, you could knock off your mortgage interest, plus other sort of fees associated with
management, agent fees, things like that.
And your tax liability would be, in some cases, zero or next to zero.
Yeah, you would pay tax on your net profit after you've deducted all the expenses. The change that was phased in is that basically, in very general terms, and again, we would always recommend that you take specialist tax advice before you launch into this, but in very general terms, now you pay tax on the gross rent.
Yeah, okay, so added to your income, and then your tax bill is calculated.
There's a specific allowance for landlords. It's the same allowance basically for everybody. So irrespective of what rate of tax you pay on the gross rent, and you get the same allowance.
And because it was phased in, it almost came as a bit of a surprise to some of these landlords.
Yeah, exactly. I think a few people sort of it came in by stealth almost, and they didn't realise until at the end of it, when they then start getting quite a big tax bill at the end of the year on it.
And the other thing was they introduced a stamp duty surcharge. Tell us a bit about that.
Well, basically, if you, in very simple terms, if you are buying a property and you start the transaction, let's say owning one property, and you end the transaction owning 2 properties, you would pay an extra 3% stamp duty over and above any regular stamp duty payment that would be made, and that would be 3% on the whole price of the property.
So if you took a £100,000 property where typically no stamp duty would be payable, you then pay £3,000 that
Correct.
you were expecting.
Correct.
But it really didn't put landlords off too much, because you'll still, history suggests that that property will go in value more than £3,000 if you hold on to it.
Exactly, if you keep it long enough. And also it's a cost that landlords would factor into when they calculate what rent they're going to charge. Now obviously there's different things to factor into that, but certainly it's an extra cost that they would factor in as to what the likely rent would need to be.
And some landlords were put off by that surcharge, and they continue to be so. And actually, the proportion of first-time buyers has increased. So it was a bit of social engineering that possibly did work in the favour of first-time buyers.
Yeah.
Another question that we get asked regularly, and it's really one for a property specialist tax advisor, is should a client start up a limited company? What kind of advice do you give to customers who are thinking about doing it that way? Because it's something that crops up quite regularly now for us.
It is, and the nub does come down to the taxation angle, which, as you say, you need to speak to a specialist, and because it will be different for every single person, depending on, for example, if you're a high rate taxpayer already, or will the rent push you into being a high rate taxpayer. I think the key considerations, the key pros and cons, if you like. First of all, from a lending perspective, it's fair to say that fewer lenders actively participate in the limited company arena. And we should say, by the way, it needs to be what's known as a specialist purpose vehicle.
That's right. So that means that the limited company that you start up can only be doing property.
Correct. So if you've already got your plumbing company and you're a limited company as a plumber, you can't just buy the properties within your plumbing company. You have to set up a separate company,
ring-fenced,
and ring-fence it exactly. So it needs to be a specific company. Fewer lenders lend in that space, so you'll have less choice, and generally speaking, because the lenders see that as potentially higher risk to them, some of the reasons that you sort of said before, you're less likely to worry about keeping up your payments if you don't even own that property. It's your company that owns it, so lenders will see that as an extra risk. So generally, the rates that they would charge would be higher to the limited company than it would be if you were just buying it as me, Joe Bloggs, individual. Mm-hmm. But in a lot of cases, all of those disadvantages can be outweighed by the fact that you can take your income, possibly as dividend income from your company, and that's taxed differently. Mm-hmm. Now, as I say, it's different for everybody. You need the specialist advice, but for a lot of people, that can then prove much more beneficial than the disadvantages of paying slightly higher rates or having slightly less choice of lender.
I think what we found was customers that kind of already own properties in their own personal name reacted by leaving those properties in their personal name, but the subsequent purchases tended to be through their limited companies.
That's right, because your limited company is a separate legal entity, and so often people would leave the properties that they already owned in their individual name because they'd effectively have to sell it to their limited company, which would generate all the additional stamp duty charges and so on. So and because it is a purchase, it's my company, but that's separate. So as you rightly say, a lot of people thought, right, we'll stick with what we've got. We won't change that. But then if we build a portfolio up any further, we'll do that through the company.
Good. So when a landlord is looking to buy additional properties, do they tend to be buying them for capital growth, or do they tend to be doing it for generate extra income?
I think often it's a combination of both, and obviously different landlords will have different priorities. If you see, for example, you do. I've spoken to people now that are seeing building up a bigger portfolio, and that becoming, it might not be their only source of income now, but they might see that as becoming their primary source of income.
So that might be like a tradesperson who thinks, I'm on the tools now, but when I get into my 50s and 60s, I don't want to necessarily be doing that.
Correct, so that's their priority. Other people see it that, okay, I'm in a good job, I'm already earning good money, I want to take advantage of the money that I'm earning now. As long as the property pays for itself, I don't really need that income, but I like the idea that in 15, 20, 25 years, when I come to retire, that I'm then going to have a nice portfolio of properties that I can then sell, generate, and generate the capital and have that available as my pseudo pension fund.
So people that want to generate some instant income might do an interest-only mortgage? Yeah,
that is a big difference between, say, the buy-to-let market and the residential market, where interest-only mortgages are much more commonplace. And obviously, if you're only paying interest on your loan and you're collecting the rent, the gap between what your revenue coming in and your outgoings going out is much bigger. It gives you more income.
Okay. And then perhaps if you're looking at something more for the future, then some of those customers tend to go on repayment buy-to-let mortgages.
Exactly, because they're looking at it thinking, well, if I can get this loan paid off, and it will be paying itself off.
By the rent from that's coming in.
The rent that comes in is paying off the mortgage for me, and I'm not really bothered about any extra income that it generates now. But in as I say, in 20 years' time, 25 years' time, if I've then paid that mortgage, if I sell that house, I get the full value of that house. to do with what I wish at that point.
We get a surprising number of inquiries from first-time buyer, first-time landlords, don't we? Which is might surprise some people. It's like, why would you buy a property for investment before you bought a home for yourself to live in? But it does come up all the time.
It does, and I guess there are some, possibly some occupations. Maybe if you're in the armed forces and you're moving around, but you like the idea of buying, buying somewhere for your future. So it does happen. From a lender perspective, clearly lenders typically want to see some sort of experience that you've been used to paying a mortgage. So whilst I'm not saying you can't do it, because there are lenders that will do it, again, it comes down to choice, and not every lender will do that, because they would see a first-time buyer / first-time landlord as a bigger risk.
Yeah, the reason that they would say it potentially is a bigger risk is that it could be a way that a customer could take out a bigger mortgage, because it's not so much based on how much you're earning, how much you can, it's more like the rental income that's coming in. Does the rental income that's coming in exceed the mortgage payment by a set percentage, like 125, 145%? And that lenders are nervous about these backdoor residential ones. So, for example, if you're buying in a different area, they get a bit more relaxed sometimes, don't they? If you live in London but you're buying a property in Leeds, then that might be.
They don't think that you're going to live there.
Yeah,
whereas if you're buying one 2 doors down from your mum's house, sort of thing, and you're going to carry on living at your mum's house and let that one, they're probably going to be a bit more sceptical.
And it's quite a good point. People do stay at home for longer, don't they? And if they've got a nice, comfortable life at home and getting all the teas cooked and the washing done, but they've got some money in the bank to invest, and they've had their families have good experience of properties, then that's how the first-time buyer, first-time landlord market can develop. What about the maximum number of properties? So we've bought what we've bought, so we've maybe started the SPV limited company up. Do different lenders have different rules about how many buy-to-lets you can have?
Yeah, very much so. And it varies quite widely. I've got customers who've got 15, 20 properties, and but not all with the same lender, because some of those lenders will only, for example, lend on maybe 2 or 3 properties, some 4 or 5. But it varies from lender to lender, and that's where your advisor comes in, because obviously there's no point in us trying to. We'll look at your whole portfolio. We'll look at the total value. We'll look at the total loan to value right across the range, because the larger your portfolio gets, lenders start to look at that. They might want to see that. They might be a bit more wary about lending higher loan to value if you've got everything at a higher loan to value already, if that makes sense. So that's where your advisor comes in. Is we would do that research for you and make sure that the lender that is being recommended is one that is actually open to you, particularly in your portfolio. Yeah,
and that's just down to that individual lender's sort of risk profile.
Correct.
So what about buying properties and refurbishing them and then releasing capital then to continue to build your portfolio?
Again, often happens. There are a few sort of general things. A lot of lenders are a bit wary of remortgaging a property that you've just bought at a low value and remortgaging that straight away at a higher value. Sometimes they're a little bit wary of that, and so very often it would need to be a sort of a 6-month gap between you buying it and then refinancing it. But even then, not every lender does that, and again, it really depends on the circumstances. But it's certainly a possibility.
So if you took some before and after pictures and kept your receipts and invoices and things, that might go in your favour.
Exactly. Yeah.
Okay. And then just finally on regulation, for some reason buy-to-let mortgages have always fallen outside of the normal mortgage regulations. Here at UK Moneyman, we treat every customer the same, so that the service is seamless whether you come into us for a residential or a buy-to-let mortgage. We're going to end up making a recommendation, but there are a couple of exceptions where buy-to-let can become regulated, and that's consumer buy-to-let and then when you're renting to family.
Yeah. As you say, consumer buy-to-let is typically where you are letting a property that you have previously lived in, and it became almost like the accidental landlord who, for whatever, back in the day, who maybe if the property market had gone against, he wanted to move, buy a bigger house to live in.
When people identify a house on Rightmove that they want to buy, and they haven't really thought about selling their house yet.
Yeah, exactly. Yeah, it's like, they might be in good jobs, plenty of savings, have got a deposit to buy the next house without necessarily having to sell their existing one.
And then the residential mortgage that we'd arrange for is a let to buy. So you've heard of buy to let. This is the let to buy. Don't do as much of that now because of the stamp duty surcharge. It kind of puts some people off. And regulated is where you're renting to a son or a daughter or a family
Exactly,
member.
and I think people often think, well, if I'll buy it just to let it to my son, or and it'll be all nice and informal. Well, unfortunately, no, it won't be, and far fewer lenders will lend in that scenario where it's a regulated buy-to-let, because I guess what they're looking at is, if you're letting little Johnny live in your house and he's going to pay the rent, and let's say little Johnny then doesn't pay you the rent, you're not going to kick him out, are you?
No.
It's your son or your daughter. So the lenders see that as an extra risk. Those loans are probably going to be more prone to potential for arrears or ultimately maybe possession. And so generally speaking, very difficult to mortgage.
So, big old subject, buy-to-let. It's been with us for a long time, and it's here to stay. And obviously we'll be delighted to help you with any questions that you've got on buy-to-let mortgages. Thanks for watching. If you're in the market for mortgage advice, please drop me an email, malcolm@ukmoneyman.com, or give us a call, and please subscribe to our channel.